Right now, a silent war is breaking out on Wall Street, and your portfolio is caught right in the crosshairs. Just when the bears thought a rough tech correction was about to drag the Nasdaq and the S&P 500 into a summer slide, Micron Technologies dropped an absolute thermal nuclear earnings bomb, and in a matter of hours, Micron shares exploded over 17%, proving that corporate demand for high bandwidth artificial intelligence memory isn't just growing, it's mutating into a vertical monster. But don't celebrate just yet. Beneath this staggering tech bounce lies a deeply troubling macroeconomic reality. While chip stocks are pumping, global energy markets are completely falling out of the bed. West Texas Intermediate crude oil has just collapsed so violently that its daily sentiment and momentum indicators have reached levels not seen since the depth of the 2020 lockdowns. Top institutional analysts on the street are openly warning that the news isn't what's driving this market anymore. Instead, ultra-leveraged ETFs, gamma squeezes, and hidden market mechanics are actively manipulating intraday prices. So are we about to witness an unhinged tech melt-up to new historic highs? Or are structural market traps quietly snapping shut on unsuspecting retail traders? The headline story for the past 48 hours is without a doubt Micron Technology's earnings. The entire financial ecosystem was holding its breath, looking to the memory chip titan for definite clues on whether the multi-trillion-dollar AI capital expenditure boom was finally slowing down. Micron silenced the skeptics instantly. Their fresh earnings numbers and forward guidance triggered a massive institutional re-rating, pushing the stock up 17.1% in a single session to close at a stunning $1,213 and change. According to analysts, Micron's high bandwidth memory chips, which are absolutely essential components paired with NVIDIA's flagship AI processors, are completely sold out for the remainder of the year and deep into the future. This massive cash injection didn't just save Micron, it single-handedly revitalized the entire semiconductor complex, sending billions of dollars flooding back into the Nasdaq tech engine. Now this got the bulls out in full force, treating this as an absolute signal of the next leg in this AI supercycle. They point out that Micron's staggering numbers prove that AI is not a speculative bubble or a repeat of the dot-com era. These hardware infrastructure companies are generating record-breaking revenues, locking in massive forward contracts, and showing bulletproof balance sheets. If the structural pick and shovel providers of the digital age are entirely supply constrained due to overwhelming corporate demand, the broader equity market has a massive fundamental floor beneath it. This would mean that record high valuations are completely justified when earnings per share are accelerating at this velocity. But the bears are urging for extreme caution, telling investors to look at the broader structure of the entire market. They argue that this heavy concentration in a handful of high-flying semiconductor names is masking severe weakness in the rest of the market. On the exact days tech was pumping, major chunks of the S&P 500 were actually down, with overall advance and decline metrics looking incredibly weak. The bears warn that we're seeing a late-stage hyper-extended narrative where capital is desperately chasing a singular theme. Because if enterprise software monetization doesn't rapidly materialize to justify these endless hardware purchases, the drop-off in capex will lead to an unprecedented oversupply crisis. Now, another thing to look at is while traders were hyper-focused on silicon, the global commodity complex has experienced an absolute bloodbath that has completely rewritten the inflation playbook for the entire S&P 500. West Texas Intermediate crude oil has completely unwound its entire geopolitical risk premium. WTI has plummeted to just $3 away from where it sat before the major Middle East conflicts even began. The velocity of this drop has sent shockwaves through the entire options market, pushing oil's 14-day relative strength index to its lowest level since September 2020. Now keep in mind, that was a time when the global economy was still frozen by the pandemic restrictions. Tie that with the daily sentiment index for crude oil plummeting to a rock bottom reading of just 12 out of 100, causing a massive institutional liquidation across the entire energy sector. For growth investors, this oil crash is the ultimate macro gift. Cheaper energy costs act as an immediate corporate tax cut, lowering logistics overhead, transport fees, and manufacturing expenses across the board. But more importantly, it completely defongs the sticky inflation narrative that we've been experiencing for the past 4 months. With energy costs cratering, headline consumer price indexes are guaranteed to cool off significantly, removing immense pressure from corporate profit margins and giving the market a pristine, clear runway to expand its multi-year valuation benchmark. Now, the bears are seeing a much more sinister message playing out in the oil pits. They point out that commodity pricing doesn't collapse to multi-year technical oversold lows simply because of geopolitics. It happens because global industrial demand is fundamentally fracturing. Major manufacturing and freight data indices are flashing warning signs indicating that global economic engines are slowing down significantly. If oil is actually crashing because the underlying consumer is completely tapped out, then the lofty double-digit earnings growth estimates currently priced in to the S&P 500 for the back half of the year are dangerously detached from reality. Now, the final catalyst driving this week's extreme volatility has almost nothing to do with traditional stock picking and everything to do with how the modern financial engine is actually engineered. There's now several market makers that are highlighting a highly bizarre and dangerous phenomenon, and that is headline news events are no longer the primary movers of daily stock indices. Instead, the market is being entirely dictated by mechanical market structure, specifically massive gamma squeezes, mechanical dealer rehedging, and the explosive volume flowing into double and triple leveraged thematic ETFs. This is creating a landscape that's characterized by extreme intraday volatility, where automated algorithms pick a single direction and aggressively squeeze short sellers, completely decoupling index prices from real economic fundamentals. The bulls argue that this structural leverage is the ultimate fuel for a legendary summer melt up. This is because institutional dealers are systematically forced to buy shares of top tech names to hedge their massive derivative books. A perpetual programmatic buying loop has been hardwired into the entire market. As long as high-margin, cash-rich tech companies like Nvidia, Microsoft, and Micron keep delivering pristine fundamental earnings, the structural plumbing of Wall Street will naturally default to squeezing the market higher, rendering old-school bearish valuation models completely obsolete. Now, the bears, of course, are issuing a definite red alert. They warn that this extreme algorithmic concentration and reliance on derivative hedging loops in a textbook recipe for a systematic liquidity flash crash. When an index direction is determined by options delta and leveraged ETF rebalancing rather than genuine organic inflows, volatility works beautifully on the way up, but becomes incredibly violent on the way down. The moment a macro catalyst triggers a genuine panic, these exact same options loops will force automated dealers to market sell billions of dollars of equities simultaneously, completely vaporizing late-stage retail accounts. So we're standing at a historic crossroads in market history. On one side, you have an unstoppable, sold-out artificial intelligence chip boom spearheaded by Micron that is breathing frantic life right back into growth equities. On the other side, global oil metrics are signaling a massive demand slowdown, while structural algorithmic leverage traps are creating some of the most unpredictable trading conditions we have ever witnessed. So I'm going to leave you with one critical question to think about tonight. Is the record-breaking velocity of this tech market actually genuine and a forward-looking reflection of a new technological renaissance? Or is this sudden collapse in global energy prices telling you the real macroeconomic truth that Wall Street is desperately trying to ignore?